Target defines itself as an upscale discount chain, which I love. They say they're an upscale discount chain. And the reason they say that is because they appeal to a more attractive demographic in terms of affluence than Walmart and Kmart do. If you look at the average shopper at Target, it's a family of four that earns around $56,000 a year, whereas the average family of four that shops at Walmart earns $48,000, and the average family of four that shops at Kmart earns $38,000. So more affluent shoppers. If you don't believe me, go look at the parking lots, and you'll see in Target a lot of BMWs, Mercedes, and Lexus, and there's a few in Walmart, and Kmart ain't never seen one. So it's just a different business model. You know, they're appealing to different demographics and on purpose. They sold two of their units recently, Mervyn's and Marshall Fields. I don't think there was a Mervyn's in Ohio. It's a middle market promotional department store is the way they described it. I don't know what that means. They didn't know what that meant really either. And it was actually a very unsuccessful chain. It was a California chain that they had acquired several years ago. Really stagnant growth, disaster, and they pretty much gave it away. They also own Marshall Fields or Dayton Hudson, which they sold to Macy's, traditional department store. I think they made the right move getting out of that space because, as you've seen, Macy's is consolidating the department store business or the industry. And it's largely a dying business in many ways. People frequent department stores a lot less frequently than they did 20 years ago, 10 years ago. People tend to go to specialty retailers for items like jewelry or clothing or shoes or handbags. And then they'll buy everyday items at Walmart or Kmart. And so what's happening is there seems to be this vast middle, the department stores, that are really, the people are just morphing away from. And I don't know if that's your experience, if you shop at department stores less than you used to. It certainly is most people's experience. And go back to my earlier comment, if there's three ways to compete, and you think about Macy's competing with Nordstrom, competing with Bloomingdale's, and Dillard's, I'm sure is owned by Macy's, is that right? I'm sure it is, I would imagine. But if you look at the three ways, again, the companies compete, and where did I put that? I think it's right here. They compete on cost, focus, or differentiation. Well, obviously, Macy's isn't competing on focus. They offer everything, right? They're not competing on differentiation, because if I go to Macy's, they sell the same stuff they do at Bloomingdale's, don't they? I mean, there's really no difference. I mean, Again, I've never been in the Dillard's near here, but I know what they sell. I know what the Nordstrom sells. They all sell the same stuff. And so they're really kind of competing in many ways on cost now. I mean, and I don't know if this is true. I'm going to imagine it is, that if you look in the Columbus newspaper, every week there'll be a new sale every day, okay? That they're having 20% off. It's the one-time Daisy sale. It's the 24-hour sale that occurs every 72 hours. I mean, they're constantly promoting, trying to move the merchandise. So they become really very more cost-oriented than anything else. And that ultimately, as I said, for a lot of reasons, is probably not a winning strategy. So Macy's will go consolidate this entire business. The only thing retailers really have that has that much value today is they've increasingly become aggregators of brands, and they offer that in a way that many don't. And I was struck by that when I was in Europe recently, because I went in the large department store in Berlin called KaDeWe. Anyone ever been there? KaDeWe. It's an amazing department store. It is truly, first of all, Berlin's an amazing city. They've spent $90 billion after the wall fell on new architecture and buildings. It is spectacular, I think. It will be a great city. It already is. But there's KaDeWe, which is the major department store in Berlin. And on the 6th floor, which I highly recommend you go to if you're ever there, they have, it's food, okay? But if you've ever been to Harrods, people think Harrods food halls are interesting. This makes Harrods look like a dump. There are 2,400 kinds of cold cuts, 2,400 types of cold cuts. It is spectacular in terms of diversity of products. But the rest of the store is a traditional department store, except that it really isn't, because actually all it is they rented out parts of the department store to elite boutiques. So you go into the store and the entire first floor is Bulgari, Gucci, Louis Vuitton, right, Rolex. And that's really what department stores are becoming. There's certainly that in Europe now. If you go to Paris and go to Galeries Lafayette, they've done a lot of that, right? If you go to KaDeWe, Harrods. So now you'll see that, I think, increasingly in the U.S. And you do see it, maybe not with the same brands, but you see Coach stores. I mean, they're just essentially real estate. It's a real estate play. I mean, and what they're doing is they're essentially leasing real estate to these name brands and letting them sort of conduct their business under the one global roof of a retailer like a department store. It's not a terrible idea, really, because if I'm a brand, I don't know that I'm really thrilled, and I know, in fact, they aren't, with people trying to sell everything, right? In other words, if I'm Coach, I don't necessarily want a sales clerk who will sell Coach, will sell, what's another handbag brand, Dolce & Gabbana, I don't know, whatever it is. I don't want them sort of saying to a customer, hey, I'm a menu, what do you like? Right? I want them promoting one product that they understand and know, because that'll be a much better sales experience. They're more convincing, they understand it better. So that's really what the brands are after. They don't want people who sort of are saying, what do you like? They want to say, hey, I'm an expert in Louis Vuitton, let me tell you all about Louis Vuitton. So it's increasingly becoming that way. I don't know long-term whether department stores can survive except by moving that way, because they really do need to do something other than focus on cost. Some of them have tried to survive by creating their own brands. So you'll see Macy's will have some of its own brands. Walmart does that, right? Sam's Club, they do that increasingly. Target does that for the reasons we talked about. But I think it was absolutely right for Target to get out of this space, because you have to, in business we talk about core competency. And your core competency is the thing that you do best that no one else can duplicate or neutralize. So Nike has never, ever made a shoe. But Nike is great at designing shoes and marketing shoes. They've never manufactured one shoe. There is no Nike factory anywhere on earth. Okay? It drives me nuts when I read about Nike factories. There are no Nike factories. There are shoes made for Nike in factories, but those are not Nike factories. They don't own the factory. They have nothing to do with the employment practices in the factory. They produce lots of shoes besides Nike. Nike's great at marketing shoes and designing them. That's their core competency. What's Honda's core competency? It's making engines. At the end of the day, Honda makes good engines. They're extremely reliable engines. They're dependable, reliable. You can put them in a snowmobile, you can put them in a car, you can put them in a personal watercraft, right? That's what they do. That's their core competency. Heinz Ketchup, the formula for ketchup. They don't even make ketchup anymore. It's just the formula, and they're a big marketing company. Okay, so, and the point of this is that Target is good at discount retailing. That's their core competency. And these things didn't fit. And so they divested themselves of these things, and that makes sense because they didn't fit. It was a good business strategy. You often hear outsourcing. That's a phrase that's used a lot. And usually now in business school, you would be focused on the idea of you outsource non-core competencies. So if you're working at a big law firm, it's undoubtedly the case that you have outsourced the copy function to some third party, right? You don't have a bunch of people who you employ who make copies. Rather, you found some third-party vendor, or you don't have your own shredding function, usually. You've got some third party who comes and shreds the documents for you, right? Or IT or whatever. So it's outsourcing of non-core functions or non-core competencies that you see increasingly in business, and that's what obviously Target is doing. General Motors did that, right? They got rid of all the parts. They spun those off or they sold them. They don't want to make Delco radios. Yeah, they used to want to make Delco radios, but they realized it wasn't their core competency, rather outsource that. Okay. What's, I think, unique about Target in many ways as a business is that they're great at merchandising. When we talk about merchandising, that really means displaying items. I think Target stores are very attractive stores personally, much more than Walmart or Kmart. They just are, and that's what their real technique is. I mean, they're great at creating a brand, using the bullseye and really displaying the stuff much more favorably than Walmart is. They're also great with a credit card. Can you go into a Target and not have them ask the inevitable question at the checkout line, if you don't pull out a Target card, do you want a Target card? You can save 10% if you open a Target card. Right? And unless you think this doesn't happen in even ridiculous circumstances, I'll tell you my experience. So I'm in Target to buy literally a package of gum because it's on my way home. All right. I'm buying the gum, and the woman asked me, $1.05, by the way, do you want a Target card? You could save 10% on this. I'm like, do I look that bad? Like I need to save 10.5 cents. I mean, is it that obvious to you that I really? But see, that's what they're trained to say, and that's all they care about, because at the end of the day, the credit cards are so much more profitable than any other part of their business in terms of margin. It's true for Ford, too. You know, Ford last year lost $6 billion making cars and earned $8 billion financing them. So they made money financing cars, but not any money building them. I mean, they become a giant finance company. And General Motors is the same way. It's really just, it's all about how do I convince you to buy my car so that I can finance it. Not, I'm going to sell you a car that's a good car, right? I don't care about that. I just need to do the finance part of the deal, right? And that's why the dealers are so focused on trying to encourage you to finance. I mean, you go into the dealer and try to pay cash. They will talk you out of it, or they'll try to. Right? Why do you want to do that? Couldn't you put your money in the bank and earn greater interest, or in the stock market? We have a great 0% financing, or 5%, or whatever. I mean, that's what they're big. No one qualifies, by the way, for the 0% financing, just so you know. Okay, I mean, the way that works is you have to be prime credit, of which is only 15% of the country. This is an amazing stat. You know that only 15% of our country qualifies as prime credit. 85% is subprime. That's an amazingly depressing number, okay? It is what it is. But so are those 15% buying General Motors products generally? No. They're at the Audi dealer, okay? But, I mean, General Motors does advertise, 0% financing, and, it's legitimate as long as you have an A credit rating. Okay, let's take a look at I'll show you the credit card profitability. Go to page 44. Because the numbers get crazy. When you look to page 44, at the same time, turn to page 50. We'll kind of toggle back here and back and forth. So on page 50, if we look, Target sold $52 billion worth of retail merchandise, $52 billion, right? And earned $4 billion before interest and taxes. And then on page 44, you see that they had $1.4 billion of revenue in the credit card portfolio and earned pre-tax $645 million. Slightly better profit margins, right? 35% versus 4%. So it's it's not particularly noteworthy or incredibly surprising that they'd rather finance you buying toilet paper than actually sell you toilet paper. It's a no-brainer. Okay? So that's why they're so keen on the finance side. In fact, as a Target employee, the only thing they care about, the only metric they measure is how many people did you sign up for credit cards. It's not how many SKUs did you scan today, how quickly did the people go through your checkout. It's who did you add to the roll of the credit card today. And if you don't do that, don't ask the question, that's a problem. All right? That's what they care about. Auto pull system, buying to the trend. This kind of goes back to the 2080 proposition we talked about earlier. Nike introduces 2,000 new shoes every year. 2,000. But it doesn't know which one will be big sellers. So how does it do that? It waits for people to buy in leading demographic areas, and those are the shoes that it actually reproduces in a meaningful way in terms of number. Because it knows it's a 20-80 rule. It knows that 20% of its shoes are going to be 80% of its revenue. So what it'll do is it'll look at leading demographic areas, and you and I do not live in those leading areas, in case you were wondering, okay? But they'll maybe introduce products in Beverly Hills or Long Island or the Hamptons, and then after introducing those products, they'll see how they sell, and they'll dial in to figuring out, okay, that particular zip code is similar to a zip code in Columbus and is similar to a zip code in Minneapolis, and we will then sell those products to those zip codes. Okay, so it's all very information-oriented now. A lot of it's computerized, and that's why you go to a grocery store, they lower the price of Coke one week, but they raise the price of something else that you buy with Coke. So it's a loss leader that week, but they figure that they'll drive people through the store. They know there's a strong correlation between buying Coke and potato chips, so they play with the prices all the time, right? No one thinks that the Coke price that varies every week, it's because the ingredients change, right? I mean, there's not huge variation in the ingredient prices every week, okay? They're playing that game, right? Bring people in, move other prices around. That's what they do. And it's a pull system, if you think about it, because They don't know what's going to be popular. I don't know ex ante what's going to be popular, do I? I mean, I have some sense of it. I can do focus groups. But at the end of the day, it's what people want. And so I'm only going to produce what people want. How do I know what they want? I figure out the areas where there's trends. I sell in those areas. I see what the sales are like, and I go from there. Contrast that with the former Soviet Union. That was a push-style system. Okay, this is my personal experience there. 1984, I go to Moscow. This is before the wall falls, right? It's the heart of the Cold War, really, or the height of the Cold War in many ways, because President Reagan was deploying Pershing II missiles to Europe. I'm just a student visiting. Okay, I had a chance to go. I'm like, oh, okay, I'll check this out. So I go to the nicest department store in Moscow. Nice, key word there, quotes, nice. All right. I go into the department store. I go to the men's shoe section, such as it was. I wake the clerk from a drunken, I'm pretty sure, vodka stupor. And I'm talking to her, and I'm like, I need size 13 black shoes. She's like, yet. I'm like, well, where are the shoes? She brings me over to a counter. It's actually a table that's piled to the ceiling with brown shoes, which I had seen before because you couldn't miss it. It was half the size of the room, all right, this room. And I'm like, okay, those are brown. And I actually tried those on. I'm pretty sure they're like a 9 or something, That won't work here because I'm a 13, or the equivalent of whatever the Russian numbers were. And she's like, yet. I'm like, well, do you have any black shoes? Yet. Do you have any shoes that are 13? Yet. Do you care? Yet. All right? It was push. It was somebody decided how many shoes to make. They made them in that size and that color, and you know what? We don't really care if you want them or not. Those are the shoes. I mean, literally, this is what would happen in Moscow when I was there. There'd be lines everywhere. All right? And you don't even know what the people were in line for. And if you went and asked them, they didn't know what they were in line for. Imagine this. Okay? But they were in line because they figured if there was a line, there was something worth having. And if you got to the front of the line, you buy it, and then you trade it to someone else for something you wanted. That was literally the way it worked. I met these Russians, of course, and I was talking to one of them, and the guy was telling me this great joke, and he said, the way it works in Russia is a guy saves all his life for a new car, and he eventually goes in to put the money down to buy the car. And they say to him, great, we're excited, because it's a very consumer-oriented service economy, and we want to do what's best for the customer. We actually take the extra step of delivering the car to your home. Guys like our apartment, right? It's like, that's great, Well, when will it be ready? Well, it'll be ready in, 6 years from today, and you give us the money, and we'll get it to you in 6 years. And so it'll be ready on March 12th, 2004. Guys like, that's great, okay? Will that be morning or afternoon? The guys live in the car, they're like, morning or afternoon? It's 6 years from now. What possible difference could it make whether it was in the morning or afternoon that we deliver the car? Well, the guys come in to fix the refrigerator in the morning, okay? I mean, literally, that's how it was unbelievable. I mean, I got off the plane in Germany, I kissed the ground. I'm like, my God, I was born in paradise, right? I mean, what a screwed up, completely messed up system. I mean, I don't know how people, obviously, they live through it, but and I have not been back since, and I'm sure Moscow is wildly different than it was when I was there, but I don't have any desire personally to return. Anyway, the other thing, if we go down a few lines, focus assortment, less selection, just-in-time product delivery, well, that's a 20-80 rule. I want to focus my assortment. I want to dial into 20%. It's going to be my 80% of my revenues. Just-in-time, JIT, that's really popularized by the Japanese in the automobile industry, but it's used by everybody today, which is have enough inventory, but not too much, right? If I go into a Target store on November 15th and I'm looking for Halloween stuff, I'm not going to find it, am I? If I go in there on December 15th in the Columbus Target store, I am not going to find a lawnmower. I'm going to be like, where's the lawnmowers? What do you want a lawnmower for, you imbecile? It's the middle of the winter. We don't have that. That's good inventory management, right? Poor companies have that kind of inventory all the time, and they don't manage their inventory well. And that's the beauty, if you think of it, of Amazon. I mean, part of the beauty of Amazon is they don't have a lot of inventory, right? I mean, that's a beautiful business model in many ways, because they don't have the cost of carrying that inventory. Or Blue Nile. I don't know if anyone's ever shopped for diamonds online with Blue Nile. The average jeweler, it's a terrible business because I've got to have all these diamonds for people who walk in. I can't just show them 3 diamonds, right? They're shopping for engagement rings. So they come into my store and I'm like, well, we want to see your engagement rings. I have 3, but I have pictures of a lot of others. That isn't going to cut it. They want to try the engagement ring on, look at, see how it looks on the hand. You can't, it doesn't work. But it's huge cost of inventory, isn't it? And I got all these diamonds, I got all this money in inventory. It's a lot of money I'm putting in inventory. Blue Nile cuts through all that nonsense. Blue Nile has no inventory. Instead, they let jewelers sell online through Blue Nile, and they take a cut. Really interesting business model, okay? Because they don't have to worry about inventory, right? They're just an intermediary. Smart idea, right? And I remember when Blue Nile went public, people were saying, oh, no one will buy diamonds on the internet. Right? Because most people buy diamonds, if this is your experience, I buy diamonds from a guy who was recommended to me by a friend who knows the right people in the diamond business. And so he gets the best deals, and blah, blah, blah. Everyone has the friend who knows the friend who has the best deal, Okay, the average diamond when it's mined, you know how much it costs from the mine for a 1-carat D flawless stone? Now, a 1-carat D flawless retails for $15,000. 1-carat D, that's a beautiful stone, right? Colorless is D. It's beautiful. $15,000 retail. To mine, it's $350. Do you think there's some gap there? Does someone make some money between $350 and $15,000? Just a little, maybe? Now, diamonds go through a lot of levels. People cut them and polish them, and there's retail and wholesale and all sorts. So there's a lot of levels. And retailers don't make anywhere near what they used to make on diamonds, but it's a profitable business. But you've got to keep a lot of inventory. That's the negative. Okay. Every business has a key metric or metrics that matter most that I measure success by. So if I'm a lawyer, it's billable hours, right? Typically. If I'm in retail, it's sales per square foot, because that's what I compare myself against Walmart. If I'm doing 300, which I do a target per year per square foot, and Walmart's doing 280, I'm doing better than they are. And I'm not doing great compared to Louis Vuitton that does 4,000 a square foot, but it's a different business, right? Neiman Marcus does 800. Costco actually does an extremely high number, over $450 a square foot. It's a really impressive number given the way Costco is organized and does business, but they have amazing sales per square foot. So that's one key metric. And you want to find in any business the metric and figure out, okay, how's the company doing vis-a-vis other companies with that metric? The other metric in retail or restaurants or many other businesses is same-store sales. Every year, McDonald's sells more hamburgers than the year before because there's more McDonald's. That is not a useful data point. To say that McDonald's had 50 billion of sales this year and last year had 48, no kidding. They opened another 2,000 McDonald's. They better. The more useful information is same-store sales. With the stores that were open, did they have more sales than they did the year before? And if that's an increasing number, then that's a certainly if it's increasing more than inflation, that's a positive sign, right? And so Home Depot about a year and a half ago announced that they were no longer going to report same-store sales to Wall Street. See, that probably isn't a good sign, is it? Because obviously, if I have good numbers, I want to tell the world about them. And if my numbers aren't so good, I don't want to tell anyone about them. So, I personally think that's the problem with Walmart ultimately will be, and the problem with Home Depot, one of the problems is they are too big, okay? And the stores are too big. You go into Home Depot, try to find a hammer. All you want to do is buy a hammer, all right? I did this. So I go into the Home Depot. First of all, Nardelli, who's now head of Chrysler, was a famous cost cutter. So when he took over Home Depot, the first thing he did was eliminate more of the higher waged people, okay? Because that's a way to save money, right? And yeah, it's a strategy. But of course, that leaves you with people who are more really short-term oriented and aren't as highly trained and frankly know nothing in most cases. And I noticed that because I hadn't been in a Home Depot in like 5 years. I walk in a Home Depot to get a hammer, and I can't find anyone that knows anything about the store. And there's people walking around, but the people are like, I think it's row 26. And I ask another person, I think it's row 29. Okay, thinking is helpful, but it would be nice to know the row. Right? So I eventually get to the right row, And I go down the row, and I counted 78 kinds of hammers. You know, I have a hard time imagining the average consumer needs to evaluate 78 types of hammers. I just do, right? I mean, I don't even know what half of them did. Anti-vibe hammer. It sounds impressive. I'm with you on that, like anti-vibe. Cool. But what does that even mean? I think I know what it means, right? It doesn't reverberate when I hit the nail. But what, do you really need 78 kinds of, think of all the inventory. All these stupid hammers. Think of how big this store is. You can't go in that store, and if you ask people what they hate about Home Depot, because Home Depot does, their response is, this store's too big. Remember how that was once their attractive selling point? You can get anything you want. It's like Walmart. Now Walmart's got groceries. You know, you go into a Walmart, it's like you're in a convention center. Right? I mean, it goes on forever. You know, there's more and more and more. Eventually, that'll be its downfall, promise. I mean, because people will go, oh, this sucks. I don't like being here. It's too big. I can't find anything. I can't get in. I can't get out. Ugh. So, but whatever. I mean, Home Depot sales are really declining significantly. And I think a part of it is because the stores don't have a feel of, A, people knowing what they're doing, and B, you know, they're not accessible. Fourth quarter, biggest quarter in retail, so there's a lot of discussion in the financial statements about that. You can look at those. Target guest car we talked about. I just threw this in. If you want, there's an annual report for Tiffany, because it's the antithesis of Target, right? It's a luxury brand retailer. They've got it. It's interesting. The other thing I threw in here, because I think it's worth looking at one of these, is page 78. Turn to page 78. Tiffany's a branding exercise, because when you think of Tiffany, what do you think of? Little blue box, right? I mean, you go to Tiffany and shop at Tiffany, I do. So that when I give a graduation gift, the person who opens it can say, oh, you got it at Tiffany's. Of course I did. You know, that's why it's a little blue box, right? I mean, it's all about the image of the company. Hey, I cared enough about you to buy you something at Tiffany's, right? Tiffany's actually has much more silver sales than diamond sales. And they're a large diamond seller, but at the end of the day, they're really more of a silver company. And there's a lot of reasons for that, including silver comes in at a price point much lower than diamonds, no surprise. And the average American consumer, if you look at the average price point for Tiffany silver, it's $297. And the reason it is because people in this country will buy anything if it's $299 or less without thinking about it. But there's some mystique about $300 and above. And if you go into a mall and look at the mall jewelers, what are all the price points? $299, okay? $199. They're rarely above $300. That is not, it's a barrier to sales. So it's a psychological barrier that they've done a lot of studies and people cannot overcome it. So for whatever reason, the other thing that I find really remarkable about the mall jewelers is if you look at what they're selling, it's always TCW. Look at every ring, tennis bracelet. It always says 3 carats. TCW, total carat weight. Okay, it's a bunch of small stones aggregated together, and it comprises 3 carats. Okay, but I'm going to state the obvious. The rarity of small stones, they aren't that rare, which means they're not that expensive, which means this is their way of taking less expensive stones and putting them together. They're eye-popping if you put them together and orient them the right way. But at the end of the day, the really rare stones, of course, are a carat and above. I'll give you one last cool statistic. I think it's cool. There's 60 million carats of diamond mined every year. 60 million carats. But a lot of it's garbage. Okay, a lot of it's not for retail. It's for cutting and everything. And of the 60 million carats, only 30,000 stones are 2 carats or above. So to get a 2-carat diamond ring, is a really extraordinary thing. That's why, you know, the good 2-carat ring's 80 grand, right? Because it's extremely rare. And if you look at where most 2-carat and above stones go, they go to one country in the world, and it isn't the US. US buys more diamonds than any other country in total because of engagement rings, all right? And that's a unique American phenomenon, by the way. It doesn't happen in Europe, generally speaking, or Asia. but one country on earth buys half of the 2-carat stones and above. Anybody?
India.
Actually, most diamonds are cut in India. Saudi Arabia. Yeah, Saudi Arabia. Yeah. So amazingly wealthy country, and they're putting their money into diamonds, apparently. But if we look at page 78, look at page 78, 79, 80. This is a research report on Target. I like to read these. Look, if I had a client who was a public company and I wanted to know about them, and there were some research reports, I'd read them. Because what better way to know about my client than to get a third party's view of my client? So I think it's good. And if I was going to buy a stock, I don't really believe that their recommendations are that helpful. Because again, Buffett says, and he's right, I think, you do the opposite of what everyone else does. Because everyone loved Enron before it filed bankruptcy. If you had followed the analyst, you would have bought Enron all the way to 80. That's what would have happened. Okay? But they're great because they give you a lot of useful information. You can make your own decision about whether or not to buy the stock, in my mind. But they're really good at teasing out the key metrics, telling you what's interesting to business, in the industry. So, and this is Lehman Brothers. They're a very good firm. And so, again, I like to read them. If I'm going to buy a stock, I want to know at least as much about a stock as I do about a refrigerator that I'm going to buy. So I'd at least like to do that. And that's what I would recommend you do if you want to learn about companies. You go buy research reports or get them from your broker, right? Because your broker, if they're a larger broker, certainly is going to have them. They'll be glad to give them to you. Call them up and ask them for them, right? Okay. If we skip ahead now, a few pages, 241, I think. So a lot of this is sort of stuff you can look at on your own about Tiffany's and Target. And if you care to, welcome to look at it, of course. I'm now on 241. So let me tell you a quick story. So Patricia Russo is the CEO of Lucent, right, which is now Alcatel-Lucent. And she decides she wants to hire a new CFO, and she's got 3 internal candidates she identifies as the likely candidates. One's a general counsel lawyer. Second one happens to be vice president of engineering and technology. And the third one is a comptroller, happens to be an accountant. So she brings the first person in, a lawyer, and she says, look, I read your resume, went to a fine law school, did well at that law school, rose to the rank of general counsel. But now I'm looking for a CFO. I think you'd be a fine CFO, but I have one question. Yeah, what's that? What's 2 plus 2? Looks at her and thinks about it. Says, I'll have to get back to you on that. I need to write a memo. But to do that, I'll look at what statutes say 2 plus 2 is, and reasonable people think 2 plus 2 is, and what cases say 2 plus 2 is, and then I'll conclude that at the end of the day, nothing is certain, but I could tell you it's somewhere between 3.9 and 4.1. All right. It's like, that's a good legal answer, kind of hedging your bets there. It sounds plausible. Lawyer leaves. The next person, vice president of engineering, happens to be an engineer, technology person. She says, you'd be promoted with this job, and I think you'd make a fine CFO. I just have a simple question. What's 2 plus 2? She looks at him. She thinks about it. She looks at her, and she says, that's a good question. Nothing in engineering is perfect. There's like no perfect 2. There's no perfect 2 plus a perfect 2. So it's really hard to answer that question in the abstract. But if I was measuring widgets, it's probably somewhere between 3.96851 and 4.13952. So like, okay, good answer for an engineer. Thanks. Final person, the accountant, comptroller, promotion to CFO, comes in, says, I've read your resume. It seems like you'd be the perfect fit for CFO. I just have one question. What's that? What's 2 plus 2? Stands up, walks over to the door into her office, closes the door, locks the door, takes an armoire and pushes it behind the door so no one can get in. She's looking at this. Goes to the windows, closes all the windows, closes all the blinds in front of the windows, closes all the drapes in front of the blinds. Says, you know what, we got to get underneath your desk. He's like, what are you talking about? Get underneath the desk. Gets right up to her ear and whispers, what do you want it to be? Okay? That's a good accountant. Right? That's what they do. They're good at getting you the numbers you want. All right? And the question that or the issue I want to just highlight today for you very quickly is, how do you really penetrate all that goop and get to the heart of what's going on with the company? Well, one thing is watch cash flows, because cash flows are far more relevant than earnings. Compare revenues and receivables. How good or bad are the customers? Is there customer concentration? I'm selling 80% of my product to Kmart and they just filed bankruptcy. That might mean something, right? Get out the magnifying glass, watch restructuring charges. Companies often do this. In a quarter, new CEO comes in, she writes down she fires a lot of people. Wall Street loves that, by the way. Fire 20,000 people, makes Wall Street very happy. You have all these restructuring charges now, and it turns out you estimate those to be 500 million, but in fact, 3 quarters later, they're only 200 million. Well, where does the 300 million come in? It comes right back as income. So people have a huge incentive to be aggressive on the R&D side or the restructuring side. Check beyond earnings, look at debt levels, gross margins, inventory levels. And let me say now a little bit about Enron, because everybody loves to talk about Enron. Enron was the Cain in many ways of off-balance sheet transactions. And I think as a result of Enron off-balance sheet transactions, quite frankly, even though they're very common transactions, even today still, they have gotten a bad rap on some level. So let me tell you what happened in Enron, at least what I perceive happened. I was an expert in one of the many Enron cases, or I'm actually in another one right now. But Enron's an interesting company. I mean, Enron did a lot of off-balance sheet transactions. In their own right, there's nothing wrong with off-balance sheet transactions. General Electric has $56 billion of off-balance sheet transactions that are accounted for or noted in its financial statements. Does anyone think General Electric's some big fraud? I don't think it is. Okay. So Enron had all this disclosure-related off-balance sheet transactions. But let me show you the transaction that ultimately led to the unwinding of Enron, doomed the company, right? And it was an off-balance sheet transaction. And let me also, I think, prove, hopefully, or convince you, perhaps, that at the end of the day, the accountants weren't really responsible for any of this because they couldn't have known about it. Because I happen to know the facts of this quite well. And much of this is a matter of public record, certainly everything I'm going to share with you. But there's even more that's not that I think would buttress this if I could share it. But here's the situation. So it's 1997, and you've got this entity called Joint Energy Development, Inc. Okay? And this is an entity where it's really owned half by Enron and half by something you maybe have heard of called CalPERS. Right? CalPERS is obviously the California Pension Fund. Okay? They've each put $250 million into this thing, and they're each 50% owners of it. That's critical, that they're 50% owners, respectively, because that means that the asset, Joint Energy Development, is not consolidated on the books of Enron. Neither the assets in that entity nor its liabilities appear on Enron's books. That's critical, because if the liabilities were to have appeared on Enron's books, Enron would violate various loan agreements that it had and various covenants in those loan agreements. It would be in default, and it would have indebtedness that came due of tens of billions of dollars. So the structure of this transaction is all made so that that is an off-balance sheet transaction. Enron owns 50, but it cannot own any more than 50%. Okay? Totally legitimate. There's nothing wrong with that. Done all the time in business. Here's what happens. 1997, June or so, Enron comes to CalPERS and says, look, you've done really well with this, as have we. CalPERS had made a lot of money owning this particular entity, and historically. And Enron said, look, we want to do Joint Energy Development, Inc. 2, which, by the way, if you take the first initial of each of the words, what does it spell? Jedi. Okay. Fastow was a Star Wars freak. He still is. I find that personally odd because any 40-year-old person who's fascinated with Star Wars, I think, needs therapy. But anyway, so he was in love with it, and so many of these transactions, they involve a lot of Star Wars type characters. Okay, so you get this whole bizarre flavor on the transaction of stuff being named after Star Wars. So they want to do Jedi 2, Enron. And they go to CalPERS and they say, look, we did really well. We're doing really well with Jedi 1. Want to do Jedi 2. We need another $250 million. CalPERS says, yeah, we would love to put money in Jedi 2. Take us out of Jedi 1. Now, that wasn't the answer they were really expecting, and not the one they really wanted to hear. Okay, but now they want to take them out. So now what Enron ends up doing is it basically ends up redeeming CalPERS for a payment of $383 million. Okay, so CalPERS loves Enron, okay, because they put $250 in, they made all this money throughout the time that This entity was involved around, and then they get a check for another $133 million on top of their initial investment. Okay, so CalPERS is happy with this transaction. Enron now owns 100% of this thing. It cannot own 100% of it come December 31st of 1997, because if it does, it's consolidated on Enron's books. Problem. Okay, so Enron does totally something that's completely, everything so far is legitimate, and what's about to happen is legitimate. Enron forms a company, okay, called Chuco. You know Chewbacca? Okay. So Enron forms a company called Chuco, and the objective of Chuco is to, in essence, buy this 50% stake. It's really not CalPERS because that had been redeemed, but to buy a 50% interest, it ends up being functionally the same, right? And to do that, they're going to spend $383 million. Now, where are they going to get the Now, it's a paper company. There's nothing in it. Okay, where does a paper company with zero in it get $383 million? Yeah, that's where you start, right? So they borrow the first $132 million from Jedi. It's just seller financing. Happens all the time. What's wrong with that? Nothing. Okay. Then they go to a bank that Enron has a relationship with. It has ones with most banks in the United States that are of any size, right? But it's called Barclays. And Barclays agrees to subordinated debt of $240 million. So now you're $372 million, right? You're $11 million short. Now that's critical because as it turns out, under the accounting rules at the time, this transaction was considered a valid off-balance sheet transaction so long as it was at least financed with 3% equity. In other words, you could borrow 97%, but not anymore. So to buy the interest, you needed to have at least 3% equity, and the balance could be financed with debt. So we've got $383 million as a purchase price. We've got $132 million of debt there, another $240 million there. So Enron has two entities that are established, not by Enron, but are established, who invest, called Big and Little River. It kind of doesn't matter, but Big and Little River. And just for sake of ease, we'll say this guy puts in, this entity, it's an LLC, invest 10, and this one puts in 1. That gets me to 11. 11 million happens to be 3% of 383 million. You now qualify as an off-balance sheet transaction. The deal closes December 30th, 1997. Oof, made it. Okay, so now it's off of Enron's books. Okay, now we fast forward 3-4 years. Things go well. Life is good. And then people at Enron start to suspect, at least one whistleblower comes forward. She won Time Woman of the Year, right? Watkins, and Cheryl Watkins. And she says, I'm worried about some things, blah, blah, blah. And so Enron forms a special committee of the board to start investigating everything, give them cover, right? And to make sure that, was there anything done improperly by Fastow or anybody else? And so they begin this massive investigation. And among other things, they ask their accountants to go back and look at all the documents and all the transactions to see if everything was done correctly under GAAP and under appropriate accounting rules in effect at the time. So they look at, Arthur Andersen was their main accountant, right? They look at this transaction. The audit partner at Arthur Andersen looks at this transaction. And in looking at the transaction, they actually meet with people at Enron, and they go through the closing books. Now anybody who's ever been in a corporate transaction, you end up with closing books, right? Has anyone ever looked at those after the closing? I mean, I have lots of them. They're on my shelf. They gather dust. I've never looked at them. Why would I? Deal's over. Money's made. Move on, right? That's yesterday. I got to move on till today, right? Make money today. So no one ever looks at these things. And I'll add one other thing. Enron does not send them to anybody in this transaction except its law firm, outside counsel, who drafted the documents, of course, and who sent these out. It seems, it's unclear as a fact, but it seems that it was sent by outside counsel and the internal lawyers at Enron. Okay? So it never gets circulated to Arthur Andersen. So now 2001, they're looking at the closing documents. It's a 4-volume set. Okay? They're looking through it. And somebody turns a page, and there's a document no one's ever seen before. And it's a side letter of 2 pages in length. And what the side letter basically says is it says that Enron's going to sell some property, and from the sale of that property, it's going to give $6 million to Big and Little River. So check this out. Equity is defined as something that's at risk, ownership interest that's at risk, if you look at the accounting rules, all right? So you have to have at-risk money, which means you have to have equity to make the 3%. But if they put $11 million in, and they've actually got $6 million back, then how much do they have at risk? $5 million, which means that it's not 97% leverage. It's actually 98.75% leverage. Okay. It's all in a side letter that's 2 pages long, which says, by the way, we're changing this critical document, and we're putting $6 million in. Now, the accountants are like, what? Where did this come from? And people at Enron are like, I don't know. Well, it's signed by you guys, and Big and Little, where did it come from? We don't know. So everyone goes nuts, right? Because the accountants are like, well, wait a minute. This whole deal is gone. You can't, you have to consolidate this on your books. We have to go back and restate the financials. And if we go back and restate the financials back to 1997, and all the liabilities of this entity are now on Enron's books, it violates all of its loan covenants. It's in default on $35 billion. Uh-oh. Okay, unwound the whole company. 2-page letter. All right. And the accountants are like, you got to report it. So they break. Enron there's this great soliloquy where they break for a few minutes, and ultimately the Enron people come back, and they're like, yeah, that's a side letter. We don't know where it came from. Okay. To this day, it's unclear where it came from, but it is in all the closing documents. All right. In his trial, Fastow, CFO, he was tried and convicted, well, he pled actually, to a variety of violations of securities laws, and obviously he's serving jail time right now. But then later, to cooperate with the government and with the plaintiffs in the Enron series of Enron litigation, he agreed to be deposed. And so in his deposition, which I sat in 9 days of, people ask him about, what about the Chuco side letter? He's like, yeah, that was a problem. And people are like, well, who knew about the Chuco? Do you know what the Chuco side letter is? Yeah, I have a vague recollection. And why couldn't we? Why was a side letter done? Well, because if we hadn't done a side letter, it would have destroyed the entire transaction, and it would have been legitimate 97.3, and we would have had all these problems. And he, by the way, says repeatedly in 9 days, but remember, I'm not a lawyer and I'm not an accountant. And he isn't. He isn't trained as a lawyer or as an accountant. He's a CFO, but you don't have to be an accountant, right? So he constantly says this. He also says, I don't recall, about 1 billion times, right? But which is typical strategy for a good deponent. But anyway, he constantly says this. And in the context of all this, what ends up happening is, so the whole thing comes unraveled, and then he says in his deposition numerous times, yeah, we got smart and decided in the future we would not use side letters. So here's what I submit to you. Now, how Arthur Andersen, they testified in Congress, the audit partner at Arthur Andersen, about this transaction in U.S. Congress, right? And they asked him, well, what about the side letter, Congress? And he said, well, I never saw it until 2001. In fact, I got Enron to certify there were no other documents. And sure enough, there's a certification letter that says these are all the closing transaction documents. It's not there. Right? It's not listed. No one knew about it except the people at Enron and perhaps their law firm. So no one, it seems that that's highly likely because the law firm prepared the side letter. So I'm going to guess they might have known about it because it was on their system, that maybe they knew about it because they prepared it. But anyway, at the end of the day, they stopped doing side letters. And what Fastow started doing after this transaction was he did oral agreements where he would say to people, and he said, the reason I did that was I realized that the problem with a side letter might be that someday someone would find it. Okay? And so he started making promises to people like this where he said to them, we'll take care of you if things go wrong. And we'll figure out a way to get you paid. We'll figure out a way to get you whole if things get wrong. Okay? What's remarkable about, I think there's a lot of remarkable things about this. First of all, company undone by 2-page letter. Okay? Secondly, if there wasn't a 2-page letter, would we have ever found the fraud? How? How? Because the people at Enron, you would have asked them, do you have any side deals? No. How do I prove you have a side deal when it's oral? Okay, maybe I can go to these guys and say, hey, was there a side deal? Except that these guys are that guy. And they did a lot of business with Enron. And personnel changeover, it was not that easy to find. Okay? So the other interesting thing about it is, so this thing, what did this thing do? It invested in oil and gas futures. You know what this would be worth today? They were long oil and gas futures. You see, Enron was in the exact right space. A lot of the strategies Enron used actually ended up being wildly successful. It's just that they got unwound when Enron filed bankruptcy. Okay, the other, I think, fascinating thing about this whole thing is that if you had been an Enron employee who had invested in Enron stock in your 401k plan, and Enron filed, and many of these people temporarily lost a lot of value in their stock, right? But what's amazing is because of all the class actions and the liquidation of Enron assets, they've recovered on average 70 cents on the dollar. And that's an amazing statistic because, of course, if somebody told me in 2000 that I was going to put all of my money in one internet stock, and come 2006, I would have only lost 30%, I would have been kissing them, considering what happened to all the internet stocks. So these people did really, really well, actually. I mean, the other side of this, of course, is what a tragedy with Arthur Andersen. I mean, the whole company, thousands of jobs, millions of dollars of people's life savings wiped out by a government indictment that ultimately got done. What happened to it at the Supreme Court? Overturned. So Arthur Andersen, I don't know what Arthur Andersen really, could they have ever known about a side letter? There's absolutely no proof in any record that they knew about a side letter or conspired with Enron to create a side letter. No, none, zero. They asked, did you have documentation? Is there any more than we have in front of us? No. What more could they do? What would you do? That's what I always think people don't appreciate. Is like, what would you have done if your client said to you, this is all I have? What am I left to do? No, I don't believe you. I really don't believe you. Show me other documents. No, I really don't have any more. Liar. Well, what do you do? What is the right course of action at that point? You do what they did, which is, they assume that they were acting in good faith because they had no reason to believe otherwise. So it is what it is. It's a sad story on a lot of levels. I mean, the guys at Enron, the joke in Houston is that Ken Lay now lives in the Cayman Islands. That Ken Lay actually didn't die, and that, in fact, he faked his own death and moved to the Cayman Islands. Now, that would be the perfect ending of this story, wouldn't it? I'm pretty confident that's not true. Skilling, who was indicted and convicted, he actually is in jail in Minnesota, of all places. So, kind of ironic. But what I find interesting, just as a casual aside, is that of the people indicted and convicted, none of them have law degrees. In other words, the largest law firm that was intimately involved in many ways, I think, with Enron, Houston-based firm, none of its lawyers were ever indicted for anything related to Enron. What does that say about the lawyers? Say about the legal community? Say about how smart lawyers are when being deposed? I don't know. I don't know the answer to all these questions. I just think it's interesting because I think it's highly unlikely that a lot of this stuff could have been done without involvement of third parties. This is my gut instinct. But maybe it was. I don't know. Okay. Applying accounting principles to legal drafting. I just want to say one brief word about the first point there. So, go back to this original. Whenever we talk about the top line, we're really talking about gross margin. Well, the top line is revenue. But when we talk about the top line, we typically talk about gross margins. We talk about the bottom line, we're talking about net margins. So look at my principle. Your client controls use the bottom line, the other side controls use the top line. So my client is going to buy your client's business for $100 million. right? And your client wants 120 million. We go back and forth, back and forth. My client's absolutely steadfast. They will not pay more than $100 million. And you are steadfast. You will not accept less than 120. So finally, we split the difference. And not by 110, but we say, look, I'll pay you 100 today and 20 million more in the next 5 years in an earnout. And if everything goes the way you think it will, then you'll get your $20 million. And if things don't go the way you think they will, I'll have only paid you $100 million. Okay? And we agree on an earnout where my client buys your company, we control the accounting, we control the company, and it's an earnout based on the bottom line. I promise you that you will never get another nickel. Because this number is subject to incredible manipulation because of SG&A. I can put all sorts of stuff through there. You couldn't write a contract, I promise, that wouldn't allow me to figure out a way to make sure that you got nothing. Okay? The famous movie, it's kind of a famous movie for this purpose at least, Coming to America with Eddie Murphy. The person who wrote the screenplay for the movie, he had a deal where he would get 5% of the income of the movie as a bonus. Okay? And the movie, now check this out, 150 million in sales, 50 million to make. I don't know, that sounds like 100 million in profit, right? 5%, he should get $5 million. He gets 0, goes insane, sues the studio, appeals it. Court of Appeals holds. Movie accounting. No movie ever makes money. It's true. Titanic, 800 million in sales, made no money. It's because they have all these sorts of goofy budgets and all this bizarre accounting treatment, so they always lose money, okay, or break even. So it is what it is, and that's why I say if the other side controls, you never want anything but a top-line concept, because how can I manipulate that number? This is not as easy to manipulate. What'd you sell it for? What'd you buy it for? We're done. Okay? There's no way to manipulate that. Versus this number, eminently malleable. Right? There's a lot I can do with SG&A. Okay, whatever the case, you want to look at 5 years worth of financial statements because the longer the term of the agreement, the less important the control of accounting. Use proper accounting terminology. People sometimes fixate on GAAP. They think GAAP's the only solution. It isn't. And if you use it, remember it's not static. At the end of the day, GAAP is not static. GAAP can change. And if I have a 5-year earnout and the people at FASB, Financial Accounting Standards Board, a group of accountants who must be very exciting to get together with, but they promulgate the GAAP rules, if they decide they're going to change the GAAP rules, I mean, I could suddenly have a terrible situation because they changed them. So I always put in my agreements, the GAAP rules that govern at the time are the ones that govern at the time of closing. You know, the GAAP rules that govern this transaction. Because I know what those are. I can read and understand what those are. Watch related party. You know, often you'll see companies that there's a lot of related party shenanigans, and that is a concern of mine. I always want to look at that. I was once asked to be on the board of a company, and I read the financials before I said no. But in the context of this, I read the financials, and there was a related party section, and after I read them, literally it took me 5 times to understand it, I thought. And so the CEO calls me up and goes, well, do you want to be on the board? I mean, you know, you haven't got back to me. And I was like, I'm just trying to understand the financials. He said, oh, that's fine. He said, can I ask you a question? I was like, yeah, what is it? He goes, do you actually own the real estate that the company leases from you? Yeah. So do you own a plane that the corporation has to use when flying on business? He goes, yeah. I said, do you own, like, and somehow license cellular technology to the company? He's like, how did you figure all this out? And well, I read it kind of carefully, you know, numerous times. He goes, I told those lawyers to make it almost impenetrable for someone to understand, okay? Now, that's a problem, obviously. Right? I mean, when you see stuff like that, I always read the related party stuff because that's the stuff where people, you know, if they're going to play tricks, they're going to play it many times to feather their own nest, and you want to know about that. Right? Okay. Corporate finance. Well, I think accounting is fascinating, but finance, I think, is even more so. And if you looked up the definition of finance, it's a branch of economics. If I looked up the definition of economics in the dictionary, it would say economics is the study of the allocation of scarce resources. So economics is the study of the allocation of scarce resources. And finance is a branch of economics is really the study of the allocation of scarce resources through time. So the key there is time. Finance is about time. And every finance problem is about those 4 elements. that I have on the board. What am I investing? How much am I going to invest? The smaller, the better. What am I going to get? What's my expected value? The bigger, the better. When am I going to get it? The sooner, the better. And how much risk or certainty is there? The more certainty, the less risk, the better. I don't care what finance problem it is. I'm opening a new office in a different country, different city. What does it cost me? What am I going to get? When am I going to get it? How certain am I? I'm going to develop a new drug. What's it going to cost? What am I going to get? How certain am I? When am I going to get it? Every finance problem is those four elements. Company's going to go public. What's the company worth? Well, what are people going to invest? What will they get? When will they get it? How certain? Every finance problem always revolves around these four attributes or elements. Okay? The perfect finance problem, I think in many ways, is a lottery ticket. It really is a great example to understand finance. So you have Powerball. We have Powerball in Minneapolis or Minnesota. And you have Powerball. And let's say that I play the Powerball this week, and I win $20 million. Ironically, I play two other lotteries and win those as well, ignoring the odds of this. Okay, so I've won $20 million each time in 3 different lotteries, except one's Powerball, one's a lottery sponsored by the Afghan national government, and the third is Uncle Bill's lottery. Okay, leaving aside the fact that it's unlawful to operate a lottery at a prize of private citizen, Uncle Bill has done this. And I've won $20 million in each lottery. Now, the interesting question in each of those cases is, what is that worth? I mean, if it's $21 million payments over the next 20 years, what could I sell those for if I wanted to? What would someone pay me for them? Or if we talk about it in corporate finance speak, what is the present value of the income stream promised the ticket holder? In today's dollars, what are $21 million payments over the next 20 years worth? And doesn't it depend on who's making the promise? And doesn't it depend on the timing? Because it's not the same. 20 million today is not the same as $21 million payments over 20 years. And that's not the same as one $20 million payment in 20 years, right? It's radically different, okay? Buying winning lottery tickets became a massive business in this country in the 90s, really late 80s, early 90s. Because, I might shock you by this, there seems to be a negative correlation between financial acumen and winning the lottery. Ever notice that? Okay. And so what ended up happening was people on Wall Street would go around and buy the proceeds of winning lottery tickets from the winners. They would pay them $8 million, knowing that they were worth $11 million. They'd pocket $3 million. It became such a vast and successful business that people would pay finder's fees of hundreds of thousands of dollars if you hooked them up with a lottery winner. So if my cousin won the lottery and I called one of these bankers and said, you know, my cousin won the lottery, he's entitled to $21 million payments, he's a complete moron, go out there and get him, okay? They would cut me a check if they signed him up. What they would do is they'd then repackage all these and sell them to insurance companies and earn interest that basically the insurance company wanted because it's risk-free money, really. I mean, they know that if they buy it, they're going to get, because all that's happened is the lottery bought an annuity. So the insurance company's just buying an annuity itself, right? I mean, it was unbelievable how successful this was for a period of time. And then Powerball and other state lotteries found that this was really outrageous, that people were taking advantage of their winners by buying these things at steep discounts. So Powerball concluded, why isn't it us taking advantage of these imbeciles? And so that's why they moved to the all-cash option, okay? I mean, literally to take advantage of their own people, which, you know, is fine, whatever. But, I mean, let's face it, the lottery is a huge regressive tax anyway. So, I mean, if anyone doubts that, you know, I mean, the people who play the lottery tend to be not the richest people in our society, okay? So it's a huge regressive tax. But whatever, it is what it is. And so when I buy a company, isn't at the end of the day, isn't it the same as buying a lottery ticket that's a winner? Because I'm buying the future cash flows of the company. When I buy an apartment building, I pay in today's dollars for the future rental income that I'm going to receive in that apartment building. I'm buying the present value of the income stream. That's what a stock is. That's all it is. It's a present value. People say, no, it's an ownership stake in a company, and that has people, and that has products, and it has marketing. It's like when I buy a building. Well, I'm buying a building, and there's trees, and there's a roof, and there's bathrooms, and slow down. That's all reflected in the rent, okay? That's why rental payments are different in really elite areas where the people are affluent and the building's well kept, and not so much in lesser affluent areas, right? I mean, it's reflective of the rent already. You don't pay for it because you like the trees. It's already in the rent payment. I mean, it all comes down to money. Sadly, it's just the reality of the way it works, all right? And I think what you'll see, hopefully, is that when you understand this kind of methodology, it allows you to value companies for purposes of a divorce settlement, or for minority shareholder dispute, or in the context of an M&A transaction, or an IPO. It's all the same. Okay, the key financial formulas we're going to look at today are the ones that I have, or I'm about to put on the screen, and those are found in your book, and I'm just going to take you through each of those. Those are found in your book if we flip ahead to page 245 on page 245. So let's look at 245. And these are the key formulas, and I'd like you to write them if you care to, but you don't have to. But I leave them blank so you can write it. The first one's the rate of return formula, and this formula asks that question. I have $80, and tomorrow, a year from now, I have $100. What is my rate of return? Okay, so that's the rate of return question that we're trying to answer. I have 80. I'm going to have 100 in a year. This is today. This is 1 year. What is my rate of return? Doesn't that sound like an SAT question? ACT question? Remember that annoying thing? And if you remember, it'd have 5 answers like this, right? Remember that exam? And if you ever studied Kaplan or any of the other things as sort of an exam prep, they taught you a couple things. One is that the whole exam is set up to trick you into choosing the best sounding answer. But in reality, you always choose the second best sounding answer. Interesting. And the exam is written so that 2 or 3 of the answers are always just throwaways. So I submit to you that, this is pretty typical, right? The question is, today I have 80. A year from now, I have $100. What is my rate of return? Most people instinctually know it isn't 133%. In fact, I think if you're taking the SAT and you fill that oval in, they just come over and take the book away from you. And they're like, maybe auto mechanic, it's a good idea. B the same way. Forget it. You're not going to answer 50%. So now you get to C. And C is 20%. And this is where, of course, they trick you. Because if people go 80, 100, high school wasn't useless after all. 100 minus 80, 20. Oh, my God, I'm going to Harvard. This is too easy. Okay? Of course, the right answer is 25. It's not 20. It's never this one, by the way. You know what statistically the odds of it being this one are? For whatever reason, the way the test is written, 13% of the time only is it E. Now, here's an amazing thing. If it was a perfect distribution of answers, it should be the answer 20% of the time, right? So actually, if you're running out of time, too late for all of us. But the right answer to choose if you're running out of time is B. Because for whatever statistically bizarre reason, it's 24% of the time the right answer. It should be, but it is. Okay? At least people have concluded have studied old SAT and ACT exams. Anyway, so what's the right formula? Well, the right formula is just R1 minus RO divided by RO. And finance is about making things that are complicated, or easy seem complicated, because obviously you can make more money that way. But so R1 is a year from now. That's 100. RO is today. 0 is today. R2 would be 2 years from now. R3, stay with me, 3 years. Okay. Not that hard. So it's 100 minus 80. What am I doing here? Divided by 80. Okay, so I think my hand is erasing it. Divided by 80. So it's 20 over 80, or 2/8, or 1/4, or obviously 25%. All right. Any question? That's pretty easy, right? The next formula, the present value formula, that's really the heart of corporate finance. You understand this, you understand much of corporate finance. And there's a lot of ways to describe present value. I'm going to use my way. Just what I feel comfortable with. There are other ways. It's CF divided by 1 plus R to the T. Okay? So it's CF divided by 1 plus R to the T. Let me set the stage for what the question is, and then you can understand the formula. So it's CF, cash flow, divided by 1 plus R to the T. Okay. This is timing, and this is risk. Okay. Remember, they're all about timing, risk, expected value, and investment. So this is trying to answer the following question. Right now, I'll make anyone in the room this deal, and you can document it any way you want. You can write up the paperwork. Your lawyers, I'm sure you know how to do that without any trouble. Right now, I will agree to pay your estate, or my estate will agree to pay your estate $1 million in 100 years. All you have to do is give me $10,000 today. You give me 10 grand today, and my estate, I'll sign whatever you want. My estate will agree to pay yours $1 million in 100 years. Or maybe you'll be here. I'm pretty confident I won't be. But maybe you will be, so you'll collect the $1 million yourself, right? And the question is that a good deal? Really, the question is, what is the present value? What is today's value of $1 million in 100 years? Because you're giving me today's value of 10,000. So to compare apples to apples, you need to take the million and adjust it to present value today, right? And so what you really need to do is you need to take this formula, you need to take, this is the numerator, $1 million, because that's what you're going to get, and divide it by 1 plus R. Well, what's R? R is risk. Well, if I was the U.S. government, what risk is there that I will repay you? What do treasuries yield right now? 5%, right? I mean, and the government is unique, because unlike Ed, they can tax to pay debts, right? They can print money to pay debts. Ed can't do this. So Ed's riskier than the U.S. government. Am I 5 times riskier? Be nice to me and say I am, So it's really 0.25. In years, timing is 100, because I'm 100 years off. So what is a million divided by 1.25 to the 100th power? I don't know. It's probably like $600. So for $600, you're giving me, that's the present value of $1 million 100 years from now. You gave me 10 grand. I made $9,400, which I'm going to put in the right accounts, and I'm going to take and make my estate $10 million, and then I'm going to gladly pay you $1 million at the end of 100 years. You know what this is called? Insurance, right? Isn't that, insurance to me is the biggest scam there is, okay? You see the big buildings, like Nationwide, whatever? They're big buildings for good reason, all right? Because it's a casino that only pays in rare cases, all right? And the only time, it's the weirdest thing if you ever think about it. I'm not saying insurance isn't good to have. It's kind of a perverse thing. You have to have it in many ways. But realize that they're making a fortune. And maybe they should, okay? Maybe they shouldn't. I'm not a policy wonk on this. I'm just telling you that at the end of the day, they're printing money, okay? And the reason they're printing money is because they have the ability to look at a broad spectrum of people, and they're like, okay, we'll insure these people. And we know a couple things when we write a life insurance policy. We know off the bat that 70% of the people that buy a policy will never pay the premiums until they die. So in other words, I will collect premiums up to a certain point when people will no longer pay them, and then they'll die after that, which means I don't have to write a check. So I've got 35 years of premiums for people I never have to pay a death benefit for, all right? Even if I have to pay, in the rare cases where people keep paying the premiums and then die, all right? Or die early, which is rare, right? I mean, that's the only time you beat the insurance company. It's a weird victory, right? I mean, I don't consider that a win, I'm like, gotcha. That would not be my last thought, okay, personally. But, I mean, I guess it's some comfort, but it's not much of one, all right? So, but they're counting on the fact that when you finally, if you keep paying the premiums, they've reinvested that money, right? They've made 4 times the money you've paid from a death benefit perspective over the life from 20 to age 78 when you pass, right? So 68 years of premiums. And sure, they'll write you the check. Maybe not happily, but they'll write you the check. And at the end of the day, they know that, it's the law of large numbers. I mean, they're playing on the fact that there's, like everything, that's a bell curve, and they know the chances of you being on one side of that bell curve are pretty rare. And most people are going to aggregate around a life expectancy of a certain amount, and that's what they're counting on. Right? Now, why would you buy insurance? Because you can't really self-insure on your own life. You could, all right? If you have a lot of income, you can, right? I mean, if you make $3 million a year, could I put $1 million aside for my own insurance? Of course I could, potentially, all right? But unless you're making huge numbers, it doesn't make economic sense, because what could I put aside? So I make $100,000. So I put $2,000 aside. I started at age 20. I have $2,000, I get the 30, I've got 20, plus I've earned some money on that. Maybe I've got 40,000. Now, by the time I'm 44, I've got maybe 100,000. I die. All right, is 100,000 going to mean a lot to my family if I'm the breadwinner, right, or one of two, or three, or whatever, and I die? Is that going to mean anything? No way. But an $8 million life insurance or $3 million life insurance policy will. So the problem with me trying to self-insure is that death, for me, it's not a statistical probability. It's either 0 or 1. I either don't die or I do die. You see, now over the broad spectrum of life insurance with a lot of policies written for an individual like any one of us, yeah, they can assess your statistical probability. So they can figure out whether or not you're likely or not likely to die, what the odds are, blah, blah. But for me, it ain't that easy. It's not like I'm 3/5 dead. I'm either dead, and I made the wrong bet by not having the insurance, or I don't die. See, that's why you can't not have it on some level. I mean, you kind of have to have it. Because if you don't, and now the interesting question is, should you maintain it when you're 75 or 80? Or is there something else you can do with it? And what's grown up is a whole industry of people who will buy life insurance policies from you, right? Because they're betting that you die at a certain time period, and they make up the difference that they paid you versus what the death benefit is. And this is throwing the insurance industry into an absolute turmoil, because the insurance industry, that's not the way it's supposed to work for them. You're supposed to stop paying. Now there's someone who will never stop paying, because, of course, they wrote you a check for $2 million. And the only way they get their $4 million is if they keep paying the premiums and you die. Right? Well, the second thing's going to happen. Okay? But they got to make sure the first one happens, because otherwise they don't collect. So the insurance company, instead of having all these policies that lapse by nature, now they're getting all these policies where people keep paying because they bought a lot. And you can sell an insurance policy because, let's face it, at the end of the day, it's a piece of property. And some states are trying to legislate this, and insurance companies are starting to try to figure out a way to fight this. But it's interesting. We're way behind the rest of the world on this curve, by the way, because in Europe, life insurance policies trade all the time. And so people have a stake in somebody's life. I mean, and that sounds a little bizarre, but I will say this. If you're 80 years old, you're going to die, right? I mean, unless you're an extraordinarily unique situation, you're going to die. And if I come to you and say to you, look, you're going to die, and the odds are good, you're going to die at 84. We'll just throw that out because of the nature of the way that mortality rates work. And right now, I can get you a policy for $2 million, which I'm going to take out on your life, and I'm going to give you $600,000 for you to go through a blood test and a urine test and have a physical. And all you're going to do is assign your policy to me. There's a lot of 80-year-olds that would be like, wait a minute, let me back up there. So you're telling me you're going to give me $600,000? Yeah, I'm going to give you $600,000. And all you're going to do is take my urine and blood and have me go through a physical and assign my policy over to you? Yeah. What's the catch? There is no catch, except that you're assigning your policy over to me. So your estate can't get the $4 million, and obviously, you have to. I mean, I can't go and write unlimited insurance policies on my life because the insurance company won't do that. They'll be like, wait a minute, you're not worth that much, okay? So I've now taken out the possibility of ever getting my estate any money from an insurance policy. But if I'm 80, why did I buy insurance to start with? For my family. Hopefully my 37-year-old son doesn't still need my help, right? I mean, if he does, I probably failed on multiple levels here, okay? So, the fact that I'm selling something which I never intended anyway to have, it's an interesting issue. Insurance companies are grappling with this right now because that's what people are starting to do. They're going to people and saying, I will get you an insurance policy, and I will get you, usually they pay 3% of the amount of the insurance policy. So $4 million, I'm going to get you a check for 120 grand. For what? For basically urinating in a cup and blood. Most people are like, wait a minute, I'm living on $6,000 a year. Good, now here's 120. That's a very attractive, now the insurance companies are going insane. Because they're like, wait a minute, that's not the way it's supposed to work, because you're going to pay all the premiums. And when you pay them all, you're going to get all the money, and we're going to have lost money on this deal. All right, so it's a fascinating issue, I think, that Congress will eventually maybe deal with. I don't know. But it's really interesting, because insurance companies are scrambling to try to figure out how to deal with it, because it's not in their business model. All right. Future value formula, last two, and then we'll take our break. Future value is just I, so it's just FV, I times 1 plus R to the T. So this asks a question, if I invest money in my IRA, $3,000, that's I, and I'm going to earn 12% a year, because I'm going to put it in the U.S. stock market, and we said the average return is 12%, and I'm going to retire in 30 years, I think it does this because I'm left-handed. I have that, lefties have the inevitable problem of writing across their own, right? You think about this, I'm always smearing my own writing because I can't not smear my own writing because I'm left-handed. So, but if you look at this, it's 1 plus R to the T. R is return. T is time period. So this is 3,000 I'm putting in an IRA times 1 plus 12 plus 0.12 to the 30th power. And what you would do if you went through this is you'd see that numbers get really large based on two factors. How aggressive or big is that number, and how much time horizon do I have? That's why I said earlier, one of the mantras of all these retirement books, save a lot when you're young, because you have now the power of compounding. Forget this formula. Let me tell you how the power of compounding works with the rule of 72, it's called. Einstein came up with this formula, or this rule. And Einstein said, look, if you take 72 and you divide the interest rate you're earning on your money into 72, 12% a year if I'm in the US market, in 6 years my money doubles. If I was earning 30%, it would take 24 years for my money to double. Okay? So why do we care? Because look at this. This is pretty awesome. So I let's say at age 20, I inherit $100,000. Okay? 26, I put it in the stock market, in some mutual fund that's an index fund. So it averages 12% a year throughout my life. At 26, I have $200,000. 32, I have $400,000. 38, I have $800,000. 44, $1.6 million. 50, $3.2 million. 56, $6.4 million, right? 62, $12.8 million, starting with 100. 68, $25 million. 74, man, I am one popular guy at the old people's home. $50 million, all right? All starting with a lousy 100 grand. Now compare that to putting the money in a bank and earning 3%, right? So at 20, I have 100. 24 years later, 44, I have 200. 68, I have 400. 68, 400, 68, 25 million. Little difference, okay? I mean, that's why everyone can be rich. It's not a big mystery how to be rich. But, you have to invest in the right investments, and that does not mean a bank CD, okay? I mean, that doesn't mean you should have money in the bank. I'm not advocating that. But at the end of the day, the people make a mistake. And there's a lot of analysis that suggests this is what people do. When you don't have a lot of money, you don't want to lose it. So you don't put it in the stock market because you can't lose it, so you put it in the bank. The problem is you'll never have a lot of money unless you put it in the stock market. See how that works? Because the bank is never going to pay you a meaningful amount of interest. It's just not going to happen. Right? People say, well, I'll put money in the bank because it's government insured to 100 grand. You know what your brokerage account's insured to? 500,000. I think that's more. Most brokerage accounts, moreover, they actually buy third-party insurance and insure the account up to a value of $25 million. So between Wells Fargo and Merrill Lynch, it is a no-brainer. Choose Merrill Lynch. I mean, it's just the case, right? That you're going to have much better protection having a brokerage account than you are having money in a bank. It just is, right? And obviously, you have a much greater chance to make money. If we look, last formula, perpetuity formula. Perpetuity is really the formula I kind of alluded to earlier. The price of real estate, price of a bond, the price of a company. In each case, this is the formula. Cash flow divided by R. Cash flow divided by R. Cash flow divided by R. So the price of real estate is really the rental payments I collect on it divided by the interest rate. So if I own an apartment building and it generates $20,000 of cash flow a year, right? I may have to go back to paper. And let's see if this is what happened in the last 30 years. So I buy this real estate. It's generating 20% or $20,000 of cash flow a year. President Carter is president. What are interest rates? 20%, 1979. Okay. What is the property worth? It's 20,000 divided by the market rate of interest. So at the time I bought it in 1979, it was worth 100 grand. And if you don't believe me, look at any rental property. It always works out this way. Okay. People go, well, yeah, but this one's nicer. Yeah, and that's why this number's higher, right? Of course it's nicer. That number's higher. It's always the way it works, right? Okay, then we fast forward to President Reagan, and interest rates go down on our Greenspan, and now it's 20,000 divided by 0.10, 10% interest rates. What happens to the price of the real property? It goes up to 200,000. Did this happen, by the way, in the last 30 years? And then finally, we fast forward to Bush, Clinton, Bush, and now it's the same 20,000 divided by 0.05. Now what's the property worth? 400,000. God, I'm a genius in the real estate market. I took 100,000, I made it into 400,000. I am so good. No, you had the advantage of lowering interest rates over the lifetime that you own the property. Okay? Isn't it axiomatic that if this number goes down, the quotient goes up? It has to. Even if you don't have math background, you know that, right? Okay? And the problem is, the inverse is true too, right? If that number goes up, this number goes down. Uh-oh. Anyone notice that happening with real estate the last couple of years? Interest rates are creeping up. Real estate's slowing. Today, the government announced that real estate sales of new homes were at their lowest point in the last 7 years. I would take some comfort in that, except that I know that next month will be at a lower point. Right? It's not going up in the short term here. It just isn't. I mean, and that's okay. You know, everything kind of works its way out. The problem I have with Bernanke is, after steadfastly saying he was not Greenspan and there would not be a Greenspan put, he goes and lowers interest rates. Come on, suck it up here. You know what I mean? You know, the answer to, how do I want to say? The answer to a difficult situation is not to ignore it, right? If I have melanoma on my arm, it doesn't go away by ignoring it, right? You know, you have to suck it up and get it removed. And unfortunately, getting it removed means we're going to have to go through a recession. There's going to have to be some flushing out, and there's going to be some pain. You know, it's the way the world works, because it's not an endless upward trend. You know, it's like this. Okay? And anyone who thinks it's like this is insane. Because again, that is a complete, absolute, no way consistent with the past. It's never happened that way in any country's economic history. There's always cycles. And we cannot get rid of the cycle. And what I cannot personally stand is the people on CNBC who are calling for them to lower interest rates a couple weeks ago. Now let's think about this. You're either in Wall Street and you believe in the market or you don't. It can't be, I am on Wall Street and I believe in the market until things get tough, then where's the government to save me? See, isn't that pathetic, really, on some level? I mean, personally, I think it's pathetic. It's either like you're a free market person or you're not. I can understand why you wouldn't be one of the two. I mean, there's a real reason to be not a free market person, and there's a reason to be a free market person. But you can't have your cake and eat it too, right? I mean, I can't say, hey, everything's free market, I get all the upside. When the what hits the fan, all of a sudden, where's the government to save me? That's what I have a problem with personally. But whatever, it's a one-trick pony. He can do this several times, and then we're going to be like Japan, where interest rates are zero, okay, and the markets and the economy is still not moving. That's what's going to happen, because eventually your ability to change events with that little trick end. So I don't know what that means long term for the. I mean, I don't think the country, it's not cataclysmic. We will work through it as we work through everything, because we have no choice. But in the short term, there will be some pain here. And like I said, you look at real estate in this country, and you look at the people who own homes that really, at the end of the day, are in way over their head. And it's hard to imagine a situation like that not ending poorly, right? I mean, how does that not end poorly? I mean, because it has to. I mean, it just has to. It's like if I eat way too much chocolate, as much as I love it, and it may be good for me in modest amounts, but at some point it's going to end poorly. It just is. So it's going to happen, unfortunately. Okay, let's take a break. When we come back, I'll talk about why interest rates move bond prices and why what the efficient capital markets hypothesis is.